Good morning, everyone. Welcome to today's webinar on rail industry ad valorem taxes. My name is Chris Donnell. I'm the Director of Audit and Support Services here at Alltranstech. So let's move ahead with the slides. A little brief Alltranstech overview. Alltranstech is one of North America's largest railcar management and consulting companies. Alltranstech manages over 325,000 railcars. Alltranstech's fleet management serves 100 plus unique customers, managing some of the largest privately owned fleets. Alltranstech's technical service group provides a full range of technical and operational support to the rail equipment supply chain. Services include field inspections, engineering, regulatory compliance, shop watch, stencil watch, and non-destructive testing and training. And before we get started with the webinar today, I wanted to go over a brief housekeeping items. The presentation will be approximately 30 to 45 minutes long. There will be an open Q&A following the presentation. Please type your questions into the questions section on the GoToWebinar panel. We provided an image here that shows the questions section as well as the handouts. Handouts are available in the handout section and can be downloaded during the webinar. This presentation is being recorded and will be available on our website following the presentation. Now here's our presenter, John Hoyt. John is Alltranstech's Manager of Tax and Audit Services. John provides ad valorem tax services to many of Alltranstech's fleet management customers. John has 44 years of industry experience. He began his career with the TTX company, where he presented valuation models before state agencies with the purpose of reducing the ad valorem tax. After leaving TTX, John worked for several accounting and consulting firms where he continued to represent the clients in the rail industry. Without further ado, John, go ahead.
Okay, Chris, thank you for the introduction, and I want to start by thanking all attendees for signing up, and hopefully this will be an enjoyable webinar for you. So anyway, just to get started, as Chris mentioned, I started with TTX, it'll be just over 44 years ago, right out of college. My first experience with TTX was primarily working out of the controllers department, working with fixed assets. And after about 5 years in the fixed asset system, I then moved to the tax department, where I was handling sales and use tax initially. But then right after I started in the sales and use tax, emergency arose with personnel and I was thrown into the property tax arena. I actually enjoyed doing the property tax and spent 13 years with TTX doing property tax and all other forms of taxes, as I said, sales and use, but also income tax. I became permanent with the property tax at TTX in 1988 and worked in it until May of '97 when I went to my first public accounting consulting firm. Through 1997 until 2018, I was, as Chris mentioned, I was working for various consulting firms doing railroads, commercial industrial property, private rail car companies. So I had a pretty good mix of everything that was going on. So without further ado, oops. Sorry about that. Overview of today's presentations. So the first thing is just briefly discuss what an ad valorem tax is, then the rail transportation ad valorem tax history, state process in determining fair market value, the Alltranstech ad valorem tax process, and then our new services that we're offering for ad valorem taxes. Oops, excuse me, sorry about that. So what is an ad valorem tax? Ad valorem tax is synonymous with property tax, and basically it's a Latin term to mean to value. They've used the term ad valorem for a long time. Some of the states are changing it over to property tax, but we still address it as ad valorem tax. For property tax purposes, the taxation can either be of real or personal property, and rail cars are considered industry. They're considered personal property in the rail car industry. And so we'll be concentrating primarily on personal property. So then how is property valued? Property value is based at fair market value. It's what they consider what a willing buyer and seller come to terms on what a sales price should be. As I mentioned, rail cars are considered movable personal property and will travel throughout the U.S., Canada, and Mexico. They also, in determining valuation, they also have to make sure that they are in line with state constitutions. Every state has a constitutional section that valuation must be uniform. So states cannot. They need to make sure that everything is in line, same assessment ratio, unless constitution there's something by law that they may have some other benefit that would change that. And then the last item is that for rail cars, it must be uniform with commercial industrial property. And as I mentioned, commercial industrial property is business personal property. So like on the commercial side, it might be in offices, office furniture, computer equipment, that type of item. Industrial property would include office equipment plus the machines operating it, inventory, all other types of assets that they would operate. So now I would like to go in and discuss with you the rail transportation ad valorem history. So this basically will go back to the 1800s, and at that time the states considered railroads a cash cow. During the 1800s, the primary way of getting out west was in the early 1800s was via the Erie Canal, but then that only took you to the Great Lakes. How then do you get from the Great Lakes out west? Railroads were a key part of that, and one of the things that states did to get railroads into their state was to provide land grants so that they were able to add tracks, add their track and bring settlers from the Midwest out west. This went through until through the 1900s, through World War II. Railroads were still a profitable source for government budgets. So if they needed money, the railroads seemed to be the ones that provided a lot of that money to them. Then post-World War II to 1980, one thing that developed with the post-World War II, prior to the U.S. entering the war, General Eisenhower was noted for being a fantastic logistics officer, and he was given the task on one of his trips to bring ammunition out east all the way to the West Coast. He discovered in that convoy that we had a terrible highway system, and then with the war with the conclusion of the war in the occupation of Germany, he loved the Autobahn, and because of the love for the Autobahn, when he became president, he developed and had the idea that we needed to have an interstate system, which now that's what we have. He was instrumental in getting us the interstate system. Now, what the interstate system did was it allowed the trucking industry to move products at a much less expense than the railroads could, primarily because they didn't have to worry about updating track, which is a significant investment on the railroad's part. So they had a free access to get products to and from locations. So that actually started the decline of the rail industry, and so what we saw in the 1970s, we saw a lot of railroad companies that were primarily out east, New York Central, Penn Central. They could no longer function as a profitable company, which then led to their bankruptcy. During the mid to late 70s, the government intervened, and they came up with the idea, number one, that they needed to deregulate the transportation industry, not only the railroad industry, but the trucking industry and the airline industry. In doing this, they then looked at how the transportation industries were taxed, and they provided federal legislation that allowed the companies to be more fairly taxed. They gave the states 4 to 5 years to get their systems in place so that they were not going to be hit with any serious fund issues. So I believe the law was signed into effect in 1976, and they had until 1980 to get this all taken care of. In addition to this legislation, what was also included was the formation of Conrail, which then took into case all the railroads that went bankrupt out east. So New York, Penn Central, I believe the Lackawanna, those companies all became part of the Conrail system. So our next comes to the property tax questions. Who assesses a tax on rail cars? How is it valued? When are they valued? And how are they valued? So, who assesses rail cars? We have primarily, since we are a movable property throughout the United States, it is determined by the state in doing the valuation. So there are 28 states that tax the value of the entire fleet of the equipment. There are 5 states that use what we call a gross receipts method, and basically the gross receipts method is based on what the railroads would pay a private car line company for use of their equipment. That is then taxed at a certain percentage, and it is in lieu of a property tax. We have 2 Native American reservations. One is down in New Mexico, the Pueblo de Yakima. They were one of the first tribal reservations to come out with a property tax on utilities and the rail industry. They're pretty much silent right now. They're not. We haven't filed with them in a long time. The other is the Umatilla Tribal Reservation, which is just outside of Pendleton, Oregon. They're still active in taxing rail cars. We file with them every year and pay a tax bill on November 15th. We have one state that does not have a system set up for state taxation, and we are responsible for reporting cars in their county on the lien date. Now, what is the lien date? The lien date for all states is basically, they say it's January 1st of a given year. So for example, what we filed in 2023 was based on the January 1st, 2022 data. So, the number of cars you owned at basically 1201, that is what is reported to the states. And the mileage is based on your calendar year operations. This next slide is the tax methods used by states. So if you look at most of the states are blue. Those are the states that have an ad valorem tax on rail cars. The one exception, as I mentioned, there was a state which requires to file the rail cars in county. That's Texas. So Texas, we have to look at the cars that you would have located in Texas counties as of January 1st, but we have a special rule that we apply to it, and it must have been sitting in that county at 12:01, and it is there for purposes of unloading, or it's just standing there, it hasn't moved. Those are cars that we have to report. You notice a significant number of the yellow states, those are all exempt from ad valorem taxation. So the states in the Midwest, 3 of them were gross receipt states, but when the federal legislation went through, they've exempted their property. Iowa and Illinois, because of changes to their constitutional section, their personal property was exempt, they became exempt. Ohio, they exempted personal property when they started what they call the CAT tax, which is involved with income. And then all the other states in that eastern sector, they always had exempted personal property. So that's the listing of the gross receipt states. The gross receipts in lieu of ad valorem, these are the active states still right now. So as I mentioned earlier, it's based on the revenues which you would receive from the railroads for use of your cars. Fortunately, there are only a handful of companies that receive revenues from the railroads for use of the cars. I can tell you, for one, TTX is one of them, because having worked there, I know that with TTX is a lessor provider to the railroads, so they have a much greater ad valorem, or they have much greater gross receipts present with the state. So in determining ad valorem taxes, there's basically 2 steps that we have to follow. The first is fleet valuation. So as I mentioned with the state filing, they do a value based on the entire fleet. So we report the entire fleet to the railroads, and then they have tables which they use to determine the valuation of your property. So it's based on, we report the cost, they have percent goods assigned to them, and then that comes up with the valuation for the entire fleet. Texas, as I mentioned, is a county filing. They only value those cars located in the county on the lien date. Once we determine the cars that are to be reported, the state will then go through, and this is the second part of the fleet valuation process. It is based on they have to allocate the value to the state. They cannot capture the whole value of your fleet and determine a tax on it. They can only capture your physical presence in the state. So that is the next step of the valuation of your rail cars. And then, as I mentioned, the gross receipts, they are strictly in lieu of property tax, and it's based on the revenues that you receive from the railroads. So we have a once the valuation is determined, it goes through the state allocation process. Now, most of the states use a state miles to total miles system, and they are highlighted in blue. Then we have the green states they have state miles to mileage allowance. So, for example, these states recognize that your presence in the state is very minimal, that you're basically just traveling through the state. And one example I like to give is a few years ago, we did a family vacation to Gettysburg. And so we left from Chicago to Gettysburg, and we spent the majority of our miles was done in Ohio. So if you based it on our total miles that we traveled to our total miles if you took our total Ohio miles and divided it by our total miles, we have like a 30% exposure in Ohio. However, we were only in the state for about 7 hours. So if you took our 7 hours of the state and annualized that and divided it into our state, we dropped to like 8% of our time was in Ohio. So that's when we talk about a mileage allowance. States recognize that you're just physically going through the state. They recognize that you're going at a much faster state or much faster pace. Now, California, they're the unique ones. They have what they determine on a total car day count. So what they do is they actually take they receive from the railroads when your car would arrive in state, and then when it departs the state. They then determine what the total days are, and then divide it by 365, or if it's a leap year, 366 days. So that gives them a car equivalency. Now, California, when I first started doing property tax, California actually did it by your car mark, which led to a higher valuation through litigation. They then went to where the car days are based on your car type code. So if you had 5 cars within a state, if you had 5 cars with the particular car type code, and you had the different marks, they did it by the marks. Where now, if they do it by the car type code, we did see some benefit by having it go to the car type code, because once you factored out car marks, it became more of a benefit to the taxpayer. The orange colored states are special weighted formula states. So they do, Nebraska, for example, we provide them a car day count every 3 years that looks, how many cars did you have in the state on the lien date? So if there's a benefit to having a car day count, we would definitely want to report it. Otherwise, they'll do a miles to miles. So this is a state where we will take a look at and see, is there a benefit to a car day count, providing them a car day count for your Nebraska presence, or do we just let it go with the miles to miles? So we do that, and if we see a change, then we will report it. And once the state accepts it, it's good for 3 years. Utah, they do a 50% miles to miles and a 50% mileage allowance. So they recognize that they do have some presence. They do have some presence in the state where cars will remain in state a little longer, but then they also recognize that there are cars that travel through the state much faster. So it's based on a 50%, a 50-50 weighting. So our process currently right now, and it's a team of people that work together in doing this. So the first step, the pre-filing, we have data gathering. So what we want to do is, if we have powers of attorney, letters of authorization, if they are still good, then we don't have to worry about getting them. And it used to be that a lot of companies would provide, every year we had to renew letters of authorization. We are now, quite a few companies, if management will allow it, they will give us a longer period of time on the letters of authorization. We don't have to be bothering them every year to get new letters of authorization, but we do realize that that's dictated by management, and you may have management that says, no, we've got to do it every year, and that's perfectly acceptable, but we're trying to help you with the process. Then we have our team that they do a data review. So what they do is they gather, and it's part of the data gathering also, they gather the cost of your fleet, make a comparison of the prior year's fleet. Do we have the right additions? Do we have the right deletions? Once we get to that point, our account managers will review it, and if they're content with what they see, they will pass it on to you, and then you have the final that, oh, we missed this car, or these number of cars should have been deleted, so we get them out of the fleet. Or if there are new cars coming on that were not picked up, we need to make sure we get them included. So it's, we work together on all that. Another part of our data gathering is the mileage information. So we gather all the mileage. We make sure we have all the mileage for you. I mean, we're good with getting the U.S. miles. We need to confirm also that we picked up all Canadian and all Mexican miles. The reason we want those, because where we have miles to miles state, the total system miles with Canadian and Mexican miles, that helps us in the denominator. Once we have all that put together, then I start doing my little piece of the work, which is uploading the information and getting returns ready to be filed. So we get the returns filed, we make sure that we are in good shape with the returns, and then we get them filed. Now, part of our post-filing is once we have it filed, then we have a chance to go back. Are there situations that we're not aware of or that we did not present with material? So here we want to look to see, are there any economic conditions that are taking place with the equipment? Are there any, for example, with the economic conditions, are there cars out of service? You might have a number of cars that have gone out of service. We need to know about that so we can report it. Do you have excess repairs? We want to make sure we have got all the repair data filed so that you can, a lot of states will give us a reduction in bail because of cars being out of service. Are there any technological changes that have taken place? So for example, as I said, when I was with TTX, the standard flat car was an 89-foot flat car. Right after I started, the double stacks came into service. So TTX had all these 89-foot intermodal cars, which basically became out of service because people using the rail liked the double stack container. So all those cars basically became obsolete as intermodal cars, so they had to be changed over to service. And then you had to add the new cars in there with the double stack, but then there's new technology of the double stack allowed for additional reductions. As I mentioned, we also look to develop allocation models to see if is there an opportunity in presenting a physical presence in the state for property tax purposes. But we've also, from my experience, we've also been able to see where allocation models can be used for possible income tax purposes when it comes to apportioning your income to a state. So that is something that can be, that has been accepted based on physical presence in the state. Once we have everything filed and we're comfortable with everything for the valuation process, we wait for the assessments to come out, and then once we get the assessments, we review it. If there is no, if it's what we estimated the assessment to be, we're good with it. If not, we look to see what happened. So in some cases, there might be additional miles that we were not aware of. We make sure that we've accounted for why there was an increase in the valuation, or why, I shouldn't say increase, why it changed from what we initially thought. Our last step in the process is our tax bill processing. So once we have approved everything and the states have signed off on it, we wait, we receive the tax bills, we make sure that the tax bills equal what the assessment is. So we go through and make sure that our assessment equals what the assessment should be for accuracy. And we've had situations, in many of the multi-jurisdiction, or I should say many of the tax bills where we make it more than one tax bill for because it's being taxed by the county. They may have varying taxing districts providing a tax bill on it. We make sure we've got all the tax bills before we authorize the payment. If we do not have all the tax bills, we look to see why don't we have them. In some cases, it might be a minimization of it. The value, the tax generated is well below the de minimis before the state will send it out. Last step is I will then either pass it on to someone in our finance group who will make the payments, but we have a few clients that will also make their own payments, and we advise them, okay, the bill is approved for payment, here's a copy of your tax bill, and this is what you're paying. Now, we are in the process of developing our own platform, and we're looking to develop a more friendly client interface. So a lot of the time that we want to save you from is having to go through. We want your review to be as pain-free as we can, and then also with your approval time, that it will streamline everything. You'll have the information provided, and if if we need to get the information from you, we can send reminders to you. You still have to provide us, either a letter of authorization. We need you to approve the mileage. What kind of stored equipment do you have? So that's the kind of stuff that this system we're implementing with a better interface system. And as I mentioned, we're looking at also looking at improving the tracking time. So the more time we have, the more time we can spend on from the gathering the data to the filing. That window between the filing and when the assessments come in, that will make open a window that gives us even more time to present better information to the state, or things that are going on in the industry that we need to make the state aware of, so that we can try and minimize your taxes. Because the gentleman that taught me, one of the things you just need to pay your fair share of property tax, and that's what we want to make sure, is that you're just paying your fair share of property tax. One other thing we want to be able to do with the new system is we want to be able that you have an opportunity. You can go on, you can see, okay, what was the historical data? I can download it. I can get copies of the returns downloaded. Are there any special reports that you need that you might be able to configure because of the way we have the system? So it's going to be, it will be helpful to both you and us in making our efficiencies and our reporting and saving you money much better. This last slide, basically, this is our team. So starting off, Gail Millis she's the Director of Revenue Management. Gail she's the data gatherer for us. So she coordinates everything to make sure that we have the letters of authorization, that comparison of fleets are from the current year to the prior year are accurate. So she's very instrumental in getting a lot of the information for me. Mike Steffes is our database engineer. He's got the fun job of making sure that he captures the cost information of the fleet at the right time. Probably the most difficult part is capturing the information on the mileage. When I started in the rail industry, there was a 2-month arrear on mileage gathering. So, for example, when the calendar year ends in December, it's not until February that we have all the mileage for the railroads. So Mike's got to keep an eye on that. He gathers all the repair information. So Mike is my go-to person. If I figure out something, have we captured all this? Mike is the one who will make sure that it gets instituted correctly. That if I need additional information, he'll get it for me. And the last person is Amy Tuxford. Amy's our person who pays the bills, and she becomes the backup for all of us to make sure that she's our last check to make sure that we've got everything reported correctly. So again, I want to thank you all. That is pretty much the end of the presentation. I want to thank you again for listening in, and happy to answer any questions you may have.
All right, thank you, John. Great job. There are a few questions that came through, so let's get those answered. All right, first question I have listed here. Can you provide more insight about the federal legislation that benefited the rail industry?
Sure, I'd be happy to. The legislation, as I said, the full name is the Railroad Revitalization Regulatory Reform Act, otherwise known as the FAR Act. So as I mentioned, you had the formation of Conrail. We had, all things went through the all the transportation industries went through this. So, but the railroad actually ended up with a better deal. So The first one is that all valuation must be similar to commercial industrial property. So, for example, we had South Carolina was valuing the rail cars using a 20-year life, 20% floor on the percent good. Here's where my income tax experience actually helped me, because what I noticed was they were using, back in the 70s, it was the old asset depreciation range on commercial and industrial property. So they were using, there were three ranges in that, and that's low life, midlife, high life. All the companies were being used at a lower economic life with a 10% floor for the valuation. So we were able to get the state to change their methodology in determining this value. So that, we ended up with the benefit from that. The next step is what the next item covered was the assessment ratio. So this is primarily probably a Southeast issue, but for example, now Tennessee, they've got a 55% assessment ratio on utilities, while commercial and industrial was 30%. So what we ended up doing, once the law went into effect, they recognized the 30% assessment ratio and applied that then to the transportation industry. So we ended up getting that benefit. So 25% of the assessment ratio value on the assessment ratio was reduced. You've got a tax rate item that has to be analyzed. That tax rate, for example, would be Kentucky, for example. Kentucky, they've actually got two tax rates when they send out a tax bill. One is a state rate, the other was a county rate. Now, on the state rate, manufacturers and distillers make out glorious on this one. They've got the lowest rate, and then manufacturers have the next lowest, and then the commercial property is the next. On the county side, manufacturing, including distillers, they're all exempt from the county rate. The state, every year, they have to go through and determine an effective tax rate that they apply to the railcar industry. So, for example, when I started doing property tax, Kentucky was probably around a 1 to 2% tax rate. The tax rate now that comes in is basically 0.0067. So that is because of the effective tax rate that is determined for our comparing industries. The last item, which is the catch-all, and it's the rail industry is the only one that receives it. The rail industry cannot have any other tax that you're not assigned to it without that is not being charged to commercial industrial. So, for example, Wisconsin is one of our gross receipts states. They initially were at 6%, and when we looked at it, what would we be paying in property tax if we did not have the gross receipts tax? Well, it turned out it was significantly less. As a result of going to the Department of Revenue and then the legislature, we were able to get the tax rate cut from 6% down to 2 to 3%. The state reviews it every year to see if they have to make any change. But that's because of what the taxation is on the other properties. And then the last benefit which the rail industry gets that the other ones do not get on this 4R Act is we can go to federal court. We do not have to take any cases to state court. It made a big difference going to federal court because now you didn't have to worry about state judges. Here in Illinois, we elect our judges, we retain our judges on all three levels. That is not the case with the federal courts. That is a disadvantage that the trucking and the airlines have. So that's basically the legislation that benefited the rail industry.
Thank you, John. Next question here. These go together. For leased cars, the lessor would be liable for tax purposes, correct? And then secondly, does it matter if the cars are net leased or full service leased?
When we are reporting any leased cars, if the car bears your car mark, we have to report it as, because they basically, It's known as owned and operated rail car. So if you've got your car mark on it, it has to be reported by you. Otherwise, if it has the lessor's car mark, they're responsible for the filing, and then depending upon how they may allocate that tax bill, that all depends on how they would do it.
Thank you. Next one here. What is the timetable for ad valorem taxes? When do you send out taxes for your customer to review? How long do we have to review? You had mentioned a shortened time frame. What is the deadline to file, and how long after filing do you invoice your customers? So there's a few questions in there. If you can
Okay. Yeah, this question is probably, quite a bit of this is more for probably Gail to answer, since she's the gathering of the data. But anyway, Gail toward the end of the year will start getting all that information together, seeing, do we need new letters of authorization? If so, she'll make sure she gets those out. Once we start getting, and everybody has signed off on the approval here at All Transtech, that, okay, these are the number of cars. Have we captured all the cars? Have we correctly taken cars off that need to be off, or do we need to add cars? Once that's done, then it's sent on to the customer, who then reviews it. We like to try and have that process done probably by the end of January. But as I said, Gail is the gatherer of that information, and I apologize if I'm mistaken. My mistake on that. For the mileage, Mike normally gets that information for us sometime in the second to third week of February. Now, the mileage information probably not as critical. That's information that's provided by the railroads, and we capture that off of railing. So that we pretty much will go with. Once we get that information, then I will begin getting my information together for filing. So we have 3 states that are due on March, 4 states that are due March 1st. We request extensions on all of them. It's been extension. When I started doing this, they were extensions back in the 70s. They're still extensions because all the data has not been gathered. March 15th, we may file an extension for the state of Oregon, only because we want to make sure we got the information going correctly to the state of Oregon. So technically, our filing starts February or March 30th, all the way then till June 1st. And it all depends upon the state that's doing it and their requirements.
All right, thank you, John. Gail is actually available, and I did make her a panelist on here. So if she's able to unmute, she can. There she is.
I did. Thank you. Can everyone hear me?
Yep, loud and clear.
Excellent. Excellent. Yes, just to follow up on what John was saying, there are a couple of critical times that we start looking at ad valorem tax process. November, December, we start looking at where's the company at, which companies are going to need new powers of attorney for the following year. We start sending information to our fleet managers to look at your fleet information just to make sure the fleets are reconciled, etc. January is a critical time. That's when we have to get the powers of attorney in, the Texas forms, the Arizona forms. So John has the authority for your company to file in the various states. January through March, that is when we gather the data both from the AAR, mileage, fleet information, make sure we have all the documents that you need to provide in order for John to move forward with what he's doing. From March through June really is when John is buried in processing the taxes, getting the information to the states. And then we have a little bit of a lull time while we're waiting for the states to come back to us with what their assessments, et cetera. And John, if he needs to go into that more, he can talk about that. But then at this time of the year, in July, August, September, we're starting to compile your tax forecasts and invoices. For those of you that have all TransTech pay your taxes. We will then send you an invoice so that you can provide the funds to us, at which point, once those tax bills come in, we immediately write them and you're covered for those particular jurisdictions. So there are different periods of time that are critical for getting information to all TransTech, but definitely the most critical is the first quarter of the year. I hope that helps.
Great, Gail. Yep. Yeah. No, thanks for the input there. That helps. Next question here. If a Canadian fleet owner use only a small portion of their fleet in the US, does it require a dedicated fleet, or does the annual average fleet in the US can be used?
Well, basically, if I was doing this, I'm required to file with the exception of it being in text, I would be required to file the entire fleet. Now, the benefit you would get is that you're probably going to have a lot more of your miles in Canada. So where we do have a miles to miles state, you're going to have that benefit because you're going to have a lot more miles in Canada. So let's say you had 100 miles total system and you only have 5 miles in the US, your allocation would be based on 5 100ths, 5%. So that that does make a little bit of a difference. And like I said, that's just an example. I mean, there are some of our clients where that seems to be the case, where they've got a larger Canadian mileage presence. They get that benefit from having all those Canadian miles. Unfortunately, Canada does not have the tax on the rail cars, so you get that benefit too. But we are required to file the entire fleet when we file the returns, because the states actually will actually do a checkup to make sure have all the cars been filed. So that they will actually look at the official equipment railway register to make sure we have that there isn't any missed cars or large differences in the mixed cars in the reporting.
Thank you, John. Next question here. If I understand your explanation of FMV, each jurisdiction can have a different method for establishing value for tax calculation?
That is correct. That was one thing when I decided to dedicate myself to property tax at TTX. I had friends say, well, why do you want to do property tax? Because everyone states it's fair market value. Everyone it's a gray area because everybody determines fair market value differently. So it's, you got that gray area is pretty large. And that's where you can kind of start having fun, is trying to figure out, okay, how are they doing fair market value in their state? So it's need to be up on fair market value determination for commercial industrial property and try and get it applied, or actually apply it then to the state at the state value on that. So it's fair market value is computed differently in every state.
John, got another question here. What are the various mandatory documents that are required to process ad valorem taxes?
Can you repeat that, Chris?
What are the various documents that are required to process ad valorem taxes?
Okay, thank you. Well, basically, I mean, the states have their returns, which we fill out. The only thing we need is on our end, and we then get it uploaded onto the return itself. The fleet, repairs out of service if it's allowed on the return, and then the mileage information. So that's really the big thing that we need in doing the returns. Any supplemental data we will also provide them, where if it's going to be a benefit for us, we would supply that that additional information.
And then if I can interject, John, the documents that you need in order to even proceed are the ones that I mentioned earlier: the power of attorney, the Texas appointment of agent form and the Arizona form. And there is sometimes confusion over why, if we've got a power of attorney, why do you need those forms for Arizona and Texas?
Mainly because they've got their own special forms.
But they are mandatory. So even though if you have if they meet the criteria, let me put it that way.
Yeah.
All right, got one last question here, unless more come in. If we are a current All Trans Tech client and we pay our own ad valorem taxes, can we ask you to pay them for us?
I can answer yes, but if Gail, you probably want to go through that a little bit more.
Sorry, I couldn't find the unmute. Absolutely, absolutely. I would say 85% of our customers have All Trans Tech pay the taxes for them. If you currently receive the invoice from John and you would like All Trans Tech to take that over for you, we're more than happy to work that out with you and give you the guidelines as to what we would need in order to make that process happen. So just reach out to me, and the slide should provide you with my email address, or you can send it to taxes@alltranstech.com, and I'll reach out to you and let you know what you need to do.
Yep, Gail, the handout that was made available to everyone has everyone's contact info in it, so they can reach out to you there.
Excellent, thank you.
No problem, thank you. And that is all the questions that we have today. If you have any additional questions, like Gail said, please reach out to either John or Gail. Their info was provided in the handout. So thank you very much for attending today's webinar. There will be a brief survey sent to you in a follow-up email, and we do appreciate your feedback on that. And so that's thank you for attending, and we hope that you have a great rest of your day.
Thank you very much, everybody.